Have you ever pondered the intricacies of constructing a well-rounded investment portfolio? The kind that's designed to weather financial storms, help grow your wealth, and set you on a path to financial freedom? If so, you're in the right place. Today, we shall delve into the process of building a diversified investment portfolio, breaking it down into simple, comprehensible steps. Step 1. Understand diversification. Diversification is the process of spreading your investments across various types of assets to reduce risk. Imagine not putting all your eggs in one basket. If one asset performs poorly, others might perform well, balancing out the overall performance of your portfolio. Step 2. Identify your investment goals and risk tolerance. Your financial goals could range from saving for retirement, buying a house, or even funding a business. The time frame for these goals will influence the kind of investments you make. Risk tolerance, on the other hand, is about how much investment loss you can handle emotionally and financially. Step 3. Choose the right asset classes. These typically include stocks, bonds, real estate, and cash. Each asset class has different levels of risk and return. Stocks, for example, are generally riskier but offer higher potential returns, while bonds are less risky but offer lower returns. Step 4. Allocate your assets. This involves deciding what percentage of your portfolio you want to invest in each asset class. A common approach is the rule of 100 minus your age equals the percentage you should invest in stocks, with the rest going into bonds and other less risky assets. Step 5. Diversify within asset classes. This means not just investing in different types of assets, but also diversifying within each asset class. For example, instead of buying stocks from one company, buy stocks from different companies in various sectors. Step 6. Regularly review and rebalance. The market changes constantly, and so will the value of your investments. Regularly reviewing your portfolio will ensure your asset allocation still aligns with your goals and risk tolerance. If it doesn't, rebalancing, buying or selling assets to return to your original asset allocation, will be necessary. To sum up, building a diversified investment portfolio involves understanding diversification, identifying your investment goals and risk tolerance, choosing the right asset classes, allocating your assets, diversifying within asset classes, and regularly reviewing and rebalancing your portfolio. Remember, a diversified portfolio is not a one-size-fits-all solution. It requires a personalized approach based on your unique financial goals and risk tolerance. And while diversification can help reduce risk, it does not guarantee profits or protect against loss in declining markets. It's always wise to seek advice from financial professionals before making investment decisions. So, there you have it, a step-by-step guide to building a diversified investment portfolio. As you embark on your investment journey, may the odds be ever in your favor in the financial markets.